Hello everyone, welcome to today's US Open. It is Thursday, February the 23rd, 14:20 GMT, 10 minutes before the US markets open. This is your host Nikos Tsabouras, Senior Market Specialist at FXCM. We have a packed session today, a lot to talk about. We had the Fed minutes yesterday. Markets also monitor continuing geopolitical tensions. Less than an hour ago, we had another round of US data, and also Eurozone CPI. And of course, we also had the Reserve Bank of New Zealand yesterday. And dominating the news is NVIDIA, which surges in pre-market after its latest results. We're going to talk about all of that. But before we begin, as always, please read carefully through the risk warning and the disclaimers, and then we will get the ball rolling. Once again, I urge you to read carefully through the risk warning and the disclaimers, and we will get started in a minute. Okay, let's go ahead and get started. So today we have mixed tones in the Forex market as investors digest yesterday's hawkish minutes from the Fed, which though lacked any surprises. We also have geopolitical tension and strained Western relationship with China and Russia. Now, in the latest data, a little less than an hour ago, we got data from the United States that showed another drop in weekly jobless claims, while Q4 GDP was revised lower. Earlier in the day, we had Euro USD. Actually, we had from Eurozone higher than expected CPI figure, actually higher than the preliminary. And of course, markets now brace for US PCE inflation tomorrow. We will talk about that at our last segment. And of course, we had the Reserve Bank of New Zealand yesterday, which moderated the pace of tightening, but stayed on its hawkish path. And of course, US stock markets brush aside the hawkish Fed minutes, partly lifted by NVIDIA's strong guidance for the current quarter, and its stock surges in pre-market more than 10%. And also Chinese tech and e-commerce giant Alibaba is up as well after solid results. Now, let's shake up things a little bit. We usually start with Euro USD. We'll start with NVIDIA actually today, and then move to Wall Street and move our way on from there. So here we see NVIDIA. The stock hasn't opened yet for today, but it gains more than 10% in pre-market, and will likely open at new 2023 highs. So what we had from NVIDIA on Wednesday after markets closed, it reported the results for the quarter ended January 29, that is Q4 of fiscal year 2023. The results were not particularly good, as both revenues and gross margins dropped on a yearly basis, although they were improved compared to the previous quarter. Now, what stood out though was the bullish guidance for the current quarter, the one that is underway, which markets like, thus the pre-market rally. Now, NVIDIA expects higher revenues and margins for the current quarter, largely driven by demand for AI, artificial intelligence semiconductors, as tech giants unveiled ChatGPT rivals this year. Microsoft, Google, Baidu, and others have all unveiled such conversational AI services. And NVIDIA's CEO, Jesse Huang, actually said that the activity around the firm's AI infrastructure has just gone through the roof in the last 60 days during the earnings call. Now, on the stock front, NVDA.US has been recovering from the October lows here, but it is capped by 50% Fibonacci of the 2021-2022 low drop, and has been having losses over the last few days. However, it will likely open above this region here with new 2023 highs based on the pre-market trading. Also, we have a golden cross formed here. A golden cross is when a faster EMA crosses below a slower EMA. I prefer the 50 days with the 200 days period crosses, and it is this cross here, which is generally a precursor of further strength. So we expect higher, and you can see the next resistance level. The 300 region is, of course, still distant, and of course we're looking at a larger time frame, a daily chart. Now, on the other hand, we've seen this slide recently, and there are expectations for more Fed hikes, another 75 basis worth of hikes markets expect, and that can weigh on the tech sector as it has done for the previous year. As such, a return back below 200, it would not be unreasonable, and we could see even a test of the 200 days EMA, but it's probably going to be hard to see sustained weakness below that level, given especially the strong results and the strong guidance actually for the current quarter. So that's it for NVIDIA. Let's now move to the Nasdaq. Markets have still not opened in the United States. We are still 2 minutes out. So yesterday, the Fed accounts of the last meeting at the start of the month, when officials had further moderated the pace of tightening with 25 basis points hike, were hawkish and reaffirmed the Fed's resolve to bring inflation down and the higher for longer narrative. However, they did not offer anything overly aggressive beyond what we knew, and the stock markets probably heaved a sigh of relief, and we see the tech-heavy index, the National 100, actually up today. What stood out from the minutes was the fact that a few participants favored a bigger 0.5% increase in that meeting, but it's a rather vague reference, I would say, and the wording definitely suggests that more, to me at least, that more than the two members that we already knew about who were non-voters were supportive of such a bigger move. Now, of course, we also have geopolitical tensions, which pose headwinds as well. We already talked on Tuesday about the United States expressing concern that China is considering the provision of lethal support, and that's a quote from Mr. Blinken to Russia in the war with Ukraine. And Western countries are probably not really excited about the two sides coming closer together as China's top diplomat visited the Kremlin yesterday. Perhaps the most important news since our last session was that Russian President Putin sparked fresh concerns, geopolitical concerns, as he announced the suspension of Russia's membership on the New START nuclear arms reduction treaty, and US State Secretary Blinken talked of a deeply unfortunate and irresponsible decision. So that's what traders contemplate. NAS 100 reacted lower yesterday to the minutes, but quickly brushed them off to end Wednesday with profits, and you can see that it's actually upbeat today. Having defended the critical region that we highlight here, which contains 38.2% Fibonacci of the December low, February high recovery, and of course the 200 period EMA, bulls are still at the driver's seat. They have not relinquished their ability to push for higher highs at around 12,900, but fresh impetus will likely be needed for that, and we are still cautious for further gains toward 13,724. It's a bit hard to, we see resilience, as we have said, but it's hard to gauge whether this resilience is because markets still underestimate the Fed or because they're simply okay with a terminal rate of 5.5% as markets now price in. In any case, the tech-heavy index is still in a precarious position, and daily close below this critical area, support area that we highlighted, will expose it to this region here from around 11,500 to 400, but sustained weakness past this level may be hard. Now let's switch gears and go onto the Forex market and look at Euro USD. The truth is that the technical outlook has not changed much from what we have been discussing for a while now. The pair is having difficulties in a poor month, pressured by the heightened expectations around the Fed and, of course, geopolitical tensions that work in favor of the greenback. Now, we see that it trades below the 23.6% Fibonacci of the recovery from the September multi-year lows, and that creates scopes for further losses to 38.2% level at mid 1.04s. However, the downside seems well protected. You can see here the lower border of the daily Ichimoku and the ascending trend line from that September low. And I think that it's hard to justify further and sustained weakness below this area based on the monetary policy outlook. From the commentary and the projections we have so far, the Fed will likely have delivered a full percentage points of hikes by the end of this tightening cycle, where the ECB will have delivered more than that. As we said, the common currency tries to hold its own, and it may get a chance to retake the 200 period EMA at around 1.072, but does not inspire much confidence for more at this point. We're a little bit on a holding pattern here to see if it can find renewed vigor. And the truth is that this correction is so far quite limited and definitely allows for a strike back, let's say. That's it from Euro USD, and let's round things off with the Kiwi, the New Zealand dollar versus the US dollar. And we're looking at the narrow chart here. And the reason we're talking about this is because we had the Reserve Bank of New Zealand downshifting to a 50 basis points rate hike on Wednesday after the previous record 0.75% move. Now, despite these slowdowns, officials maintained guidance for more increases and the projection for a terminal rate of 5.5%, which points to another 75 basis points worth of hikes. The overall hawkish stance helped the Kiwi yesterday, you can see here, but marginally so, and is a bit mixed today. It heads towards a losing month, the first in September, despite the fact that the RBNZ is one of the most aggressive central banks, having started all the way back in late 2021 and maintained its hawkish stance. But again, it's about the US dollar, which is boosted by the repricing around the Fed's terminal rate. Now, at the technical front, the Kiwi is still in risk of fresh 2023 lows. This is it, just below 0.62, although further losses below 0.6146 may prove elusive in the near term. On the other hand, the Kiwi has managed to avoid lower lows, and we can see a push for this region here, 0.6467, I'm sorry, but catalyst will be needed for further recovery towards 0.6325. So that's it from the Kiwi as well. And now let's go to our last segment where we talk about what's coming up. Now, tomorrow, the main event is the January personal consumption expenditures from the United States, following higher than expected CPI inflation figures last week. Now, the core PCE printed 4.4 year over year in December. That is the Fed's preferred measure of inflation, while the headline had come in at 5%. Both those figures were the lowest in over a year, and of course we'll be on the lookout for any Fed commentary. Of course, Friday starts with Japan's inflation. CPI Express Food has been rising well above the central bank's 2% target and hit 4% in December, the biggest increase since 1981. Also comments from Mr. Ueda, who has been nominated to succeed Mr. Kuroda, who will be in the spotlight. Kuroda, of course, being the current governor, who will step down in early April. Other than that, we also expect Germany's Q4 GDP, final Q4 GDP. The preliminary had showed a contraction of 0.2% quarter over quarter. Now, until our next session in Tuesday, in terms of earnings, we expect Chinese EV startup Li Auto and US retailer Target. These are what stand out next week before our Tuesday session. So that's it from me for today. As always, we will talk again on Tuesday at 14:20 GMT, 10 minutes before US markets open. Thank you for joining me.